My portfolio is now up 57% in the past year, with nearly half of it now sitting in Palantir. But here's the catch. I'm not sitting on paper gains. I've been applying covered calls, not to hedge out of fear, but to harvest profits and roll premiums for passive income. Let me walk you through the whole strategy. Hey everyone, it's the Investment Diary. Today I'm walking you through my $100,000 portfolio. Not a paper plan, but my actual, real money. This portfolio has evolved with both wins and mistakes. And in this breakdown, I'll go through all 24 stocks I currently hold. We'll explore the business model behind each, what I believe about the valuation, and exactly what I plan to do next. Before we begin, please help to like and subscribe to follow more about my real investment strategy and learnings so we can all grow our portfolio together. Let's start the portfolio review with my largest position. Number 1, Palantir. Ticker symbol P. Palantir is my highest conviction play. I originally allocated just under 14% of my capital, but it has grown to nearly half the portfolio thanks to a plus 588% return. Current portfolio weight of 48.8%. Palantir is a leading data integration and AI software company. Operating through its platforms, Gotham and Foundry, it blends massive data sets into actionable intelligence used by governments and enterprise clients in sectors like healthcare and logistics. But with the stock now trading around $140, the real question is Palantir still a buy? Or is this where we start trimming? Let's break down the business, the numbers, the valuation, and what I'm planning to do with my position, based on real fundamentals, not just hype. Palantir doesn't just store data. It turns complex, messy data into mission-critical insights. Their tools are designed for decision makers, and they're deeply embedded in the workflows of governments and Fortune 500s. This is higher attention software. Let's talk about earnings. Palantir's Q1 2025 numbers were strong across the board. Revenue grew 39% year over year to $884 million. U.S. revenue alone grew 55%. Net income more than doubled to $214 million. They raised full-year revenue guidance to $3.89 billion, or about 36% growth over 2024. This is no longer just a story stock. Palantir is now profitable and scaling. And the U.S. commercial business, up 71% year over year. The commercial flywheel is real, and the market is finally starting to reflect that. Here's where things get tricky. Palantir is currently trading at forward pay of above 200. Asterisk. Its EV to sales multiple is extremely rich. Asterisk. Most DCF models, and I mean most, peg its fair value below $100 per share. Some analysts say it's over 90% overvalued at current prices. So yes, Palantir is but it's also priced for perfection. So here's what I'm doing, and it's what I've already been doing. I've sold covered calls on 80% of my PLTR position, currently deep in the money, more than 50% below current prices. Why? To harvest profits without fully exiting. These calls generate premium income, which I roll before expiry to keep compounding cash flow. Meanwhile, I still hold 20% fully uncovered to stay exposed to upside in case Palantir continues to run. This is how I'm turning a high-growth winner into a cash flow machine, while still riding the AI trend. Palantir is still a phenomenal company, but even phenomenal companies can be overvalued. But with a stock price that's already run far ahead of DCF models, I'm not adding here. I'm managing, I'm harvesting, and I'm letting options work for me. What about you? Are you holding Palantir? Thinking of buying more? Or are you locking in profits? Number 2, Alphabet. Ticker symbol G. Alphabet, the parent of Google, a core position in my portfolio. Currently sitting at a portfolio weight of 7.06%. We'll look at its business, latest results, valuation, DCF analysis, and what I'm planning next, based on the current of around $178 as of recording. Alphabet is the parent company behind Google, YouTube, Google Cloud, and other bets like Waymo and Verily. Google Search still accounts for over 50% of global clicks, making it a massive cash-generating engine. YouTube and Cloud are high-growth pillars, while newer segments benefit from AI investment and deep R&D. It dominates digital advertising. Palantir is the most widely used search engine in the world and is building out a competitive cloud business. Google Cloud is now profitable, and their AI research through DeepMind and Gemini continues to lead. In the first quarter of 2025, Alphabet reported revenue of $90.2 billion, up 12% year. Google Cloud grew 28% to $12.3 billion, with operating income more than doubling to $2.2 billion. YouTube ads came in at $8.9 billion, growing over 10%. Net income rose 46% to $34.5 billion, and earnings per share hit $2.81, beating estimates by a wide margin. So Alphabet is profitable, growing, and still dominant across its verticals. But what about valuation? Right now, Alphabet trades at about 19 times forward earnings, a discount to many of its tech peers. DCF models vary, but most place fair value between $165 and $195 per share. One conservative DCF puts fair value at $142, while more optimistic estimates go as high as $230. I personally believe Alphabet is undervalued. The core ad business remains a cash machine. Cloud is now a margin contributor, and their AI infrastructure, including the Gemini model and AI integration into search, is just getting started. At this level, I'm looking to add on dips below 1. If it breaks out above 200, I'll consider trimming and reallocating into more discounted names. Risks, of course. The biggest are regulatory. Alphabet is facing ongoing antitrust lawsuits in both the US and Europe, especially around default search status on mobile and browser devices. If forced to break up or change business practices, it could reduce the moat, especially in search. Also, they're ramping capital expenditures expected to exceed $75 billion this year, mostly on AI infrastructure. That could pressure free cash flow in the short term. Still, with high margins, a fortress balance sheet, and dominant global platforms, I believe Alphabet is one of the most durable companies in the world. To summarize, Alphabet is a buy for me at current levels. The valuation is reasonable, the growth outlook is strong, and the company is adapting well to the AI era. I'm holding, adding on dips, and keeping an eye on regulatory developments. What do you think? Are you adding to your Google position, or have you taken profits? Number 3. Novo Nordisk, ticker symbol UN. Third in my portfolio, we have Novo Nordisk, a major player in my healthcare allocation with a current weight of about 5.8% of the portfolio. Let's unpack the business, growth drivers, valuation, and my actionable outlook. Novo Nordisk is a Danish pharmaceutical company, best known for its GLP-1, drugs Ozempic, and Wegovy for diabetes and obesity treatment. They also have insulin pens, growth hormone therapies, and smart dosing tools integrated into healthcare ecosystems. In Q1 2025, revenue climbed 19%, reaching approximately 3.89 billion euros. Net profits surged 14% to 3.89 billion euros, driven by a robust 67% growth in obesity treatments. Despite slightly reduced growth guidance for 2025, analysts from JP Morgan and UBS see upside, while others express caution around pricing, pressure, and competition. Valuation today stands at around 16.7 to 18.7 times. Forward earnings a significant discount to recent highs of approximately 27x. The trailing PE is approximately 20.6x, down from a peak of approximately 27x over the past 3 years. Enterprise value sits near $355 billion, with an EV/EBITDA multiple near 15.7 times. An FCF yield around 3% reflecting strong cash flow and consistent dividend payments with a yield in the 2 to 3% range. Novo Nordisk continues to dominate metabolic health, with durable 44% operating margins, significant ROIC near 89%, and strong FCF. The near-term drag stems largely from discounting in the U.S. competition from Eli Lilly's Zepbound and pending pricing reforms, using a 5 to 10% discount to peer multiples and conservative growth assumptions. Fair value likely ranges between $130 and $160 per share. The current market price of around 77 United States dollars appears undervalued given pipeline strength and profitability, stability. Verdict, buy, with conviction. GLP-1 drugs provide a strong moat in cash engine. The valuation pullback creates a margin of safety. Near-term risk from pricing and competitor dynamics exists, but the long-term secular health trends remain intact. I'll continue to accumulate on dips, especially if price falls towards $70. I believe the market is mispricing long-term stability and growth. I'll hold this position for now, with the possibility to add more into 2025 as data clarifies market share and pricing developments. Number 4. Microsoft, ticker symbol MS. Microsoft is a global leader in software, cloud infrastructure, productivity tools, gaming, and AI at its core are Windows, Office, LinkedIn, and Azure. Microsoft is aggressively investing in artificial intelligence, especially through its partnership with OpenAI and internal Copilot tools. The company continues to expand its platform reach via AI, gaming, professional networking, and devices. In the fiscal third quarter of 2025, Microsoft posted revenue of $70.1 billion, 13% year-over-year, increased and net income of $25.8 billion, or $3.46 per share, beating expectations. Azure and cloud services grew 33% year-over-year, contributing significantly to the intelligent cloud segment, reaching $26.8 billion. Productivity and social platforms also showed balanced growth, and operating margins expanded to 45.7%. Microsoft continues to return capital to shareholders. The company repurchased $9.7 billion and paid dividends in Q3 2025. Microsoft trades at about 32.8 times forward earnings and a TTM/PE of 38 times, slightly above its historical range. While premium, it's priced for sustained growth. Here's how I see it. Big picture. Microsoft is benefiting from enterprise AI adoption and massive cloud scale. Valuation, tension, fundamentals justify a premium, but DCF analysis suggests 40 to 60% overvaluation at current prices. Analyst optimism. Street consensus supports further upside to $600 plus. Strategic approach. 1. Maintain core position, given resilience and leadership. 2. Consider adding on dips below $450. 3. Look to trim if price exceeds $600 to rebalance and capture gains while staying invested. Microsoft is a global tech powerhouse with strong growth drivers: AI, cloud, productivity, and gaming. While current multiples are rich, they reflect high confidence in future expansion. Managing exposure with partial rebalancing makes sense in this environment. Number 5, we have DBS Group, ticker symbol D025. DBS is Singapore's largest bank and a standout in digital banking and regional financial services. It has benefited from rising interest rates, prudent risk management, and strong exposure to ASEAN growth. It accounts for roughly 5.5% of my portfolio. And I'm going to break down the business, recent results, valuation, and what I plan to do next. DBS is a full-service financial powerhouse, offering consumer and corporate banking, wealth management, treasury services, and insurance across Singapore and Asia. Think of it as a digital-first institution with sprawling reach. What makes DBS special is its seamless combination of everyday banking services and high-tech digital transformation. In Q1 2025, DBS reported a record profit before tax of 3.44 billion Singapore dollars and net profit of 2.9 billion, which beat expectations despite falling about 2% year-over-year due to a higher global minimum tax. Total income rose 6% to a new high of 5.91 billion, while non-interest income climbed 25%, driven by increased wealth and trading operations. Net interest margin held steady around 2.12%, and return on equity came in at 17.3%, both strong metrics for a bank in this environment. DBS also declared a healthy dividend of 60 cents per share plus a 15-cent capital return, signaling both confidence and discipline in returning capital to shareholders. The bank's strengths are clear: strong balance sheet, solid capital ratios, consistent earnings, and a twin focus on digital banking and wealth management. The capital return and buyback program further boosts confidence in its ability to generate and allocate excess cash. On the flip side, DBS faces macro uncertainties, trade tensions, possible economic slowdown, and interest rate volatility. These factors could pressure borrowing or margins, but the bank has already set aside 205 million SGD in provisions to buffer potential credit stress. I'm holding my current position, and I plan to add more on dips below 40 SGD. I may consider trimming around the high 50. If the stock approaches Lynch-based fair value, I'm holding for stability and income. If rates fall or the stock corrects, I'd consider increasing my allocation slightly. Number 6. Tesla. Ticker symbol T. Tesla, one of the most volatile and headline-grabbing stocks in my portfolio. I'll walk through what the company does, the key metrics from Q1 2025, valuation levels, and exactly what I'm planning to do next. Tesla is known primarily as the EVO company that revolutionized the auto industry, but it's much more. The company builds electric vehicles from the mass-market Model 3 and Y to the premium Model S and X. They also manufacture battery and energy storage systems, solar roofs, and are betting big on autonomous driving and robotaxi. Recently, Tesla launched its limited robo-taxi service in Austin, marking the first iteration of its long-term vision to monetize autonomy. Tesla trades at an eye-popping forward PE of around 100 compared to an average of about 110 over the last year. Its trailing PE is roughly 178, a massive premium over legacy auto. EV2 sales stands at around 10.6 times, and EV/EBITDA is near 81. Even conservative analysts say Tesla is priced for perfect execution. BS argues the robotaxi story is already priced in at current levels. Tesla currently takes up a portfolio weight of 4.83% for my portfolio. To me, it is playing for the future world of robotaxis, AI driving, and energy ecosystems. But right now, with earnings and deliveries under pressure, I'm managing this position conservatively. The story is compelling, but the price demands perfection. My verdict: hold with caution. Tesla remains a higher risk, higher reward name. For me, I'm holding my current stake because the robotaxi vision and autonomy are real and potentially transformative. But I'm not adding at these valuation levels. If the stock dips below $300, I may consider adding. If it climbs towards over $400 and narrative dominates over fundamentals, I'll likely trim. Number 7. ASML is the only supplier globally of extreme ultraviolet lithography machines, which are the most advanced machines used to print cutting-edge chips. Its systems are vital for making AI smartphone and cloud data center chips at nodes below 7 nanometers. The company also produces non-EUV systems for older chips and runs a large services and support business. They have near monopoly pricing power, long lead times, and are a linchpin in the semiconductor supply chain. ASML is a foundational holding for anyone bullish on AI and the future of computing. The Q1 report confirms strong fundamentals, revenue margins, and shareholder returns remain robust. The valuation reflects near-term optimism, but modest pullbacks could present compelling entry points. Number 8. I have NVIDIA, ticker symbol UNV. This has a portfolio weight of 2.36%. NVIDIA is the hardware engine behind the AI revolution. Its GPUs power model training and inference across nearly every major AI company. The CUDA software stack creates lock-in that is hard to replicate. Valuation is sky-high, but so is revenue growth north of 50%. I believe NVIDIA is fairly priced given its market dominance and ecosystem control. I'm holding this core AI play and do not plan to add more until valuation becomes more attractive. Next, we have Mapletree Pan-Asia Trust portfolio, weight of 2.10%. Mapletree Pan-Asia Trust provides consistent dividend yield and is backed by quality assets in Singapore and North America. Rising interest rates have pressured REITs broadly, but the trust's fundamentals remain intact. I'll continue to hold, but I'm watching interest rate developments closely. If yields stabilize, I may increase my stake. Next, we have CrowdStrike. CrowdStrike is the gold standard in cybersecurity, particularly in endpoint detection. Their subscription-based Falcon platform uses AI to proactively monitor and neutralize threats. It trades at quite a steep valuation now, but growth and renewal rates are excellent. High gross margins, sticky customers, and tailwinds from rising cyber threats make this a compelling long-term story. Full disclaimer, I have been trimming down CrowdStrike and redeploy the funds for my other bets. Next one, we have Alibaba. Was once a no-brainer for China growth. Now, with increasing regulation, slowing domestic consumption, and political headwinds, it's become a value trap. The stock looks cheap, but the risks remain. I've lost conviction in its ability to I plan to exit this position and reallocate into US or Southeast Asian tech names with clearer governance and growth path. Next, I have another real estate play, which is Mapletree Industrial Trust, ME8U. Mapletree Industrial Trust owns a diversified portfolio of industrial properties and data centers. It currently has 56 properties in North America, including 13 data centers, plus 83 in Singapore and 2 in Japan. Total assets are about 9.1 billion Singapore dollars. This mix of industrial sites and data centers gives the trust stable lease income plus exposure to the growing digital infrastructure market. Data center assets now represent over 55% of its AUM. The REIT offers a dividend yield around 7%, with a payout ratio of just over 100%, which is typical. Returns over the last decade have averaged about 10.6% annually, including dividends, based on historical performance. Overall, I still think MIHU is a solid income asset with growth exposure to data centers. At approximately 2 SGD, it looks fairly priced if rates remain stable. The approximately 7% yield and strong earnings make it attractive. Next up is a company that is used to be my top favorite. You guessed it right, it is Apple. Apple is a global tech company known for its iconic product ecosystem, including iPhone, iPad, Mac, Apple Watch, and services like the App Store, iCloud, Music, and more. The ecosystem drives recurring revenue and high user loyalty. In its fiscal Q to 2025, Apple posted $95.4 billion in quarterly revenue, up 5% year over year, and diluted earnings per share rose to $1.65, up 8% from a year ago. Services, which include digital offerings and subscriptions, reached an all-time high, and margins remain robust. From a valuation perspective, Apple trades near 20 forward earnings, with a strong free cash flow yield around 4% and a history of substantial share buybacks and dividends. DCF models generally point to fair value close to current prices, factoring in growth in services and hardware refresh cycles. Apple's combination of hardware, services, momentum, cash flow, and shareholder returns makes it a core portfolio holding. I'm holding and will add modestly if it dips below $170. Coming next, I have Visa. Nothing much to say. It is one of the best money printing business. Visa remains a secular winner in digital payments. I'll hold and look to add on any pullback toward the mid-160s. Next up is CapitaLand Integrated Commercial Trust, or CA3HU, one of Singapore's largest REITs. CICT has a diversified portfolio of retail and office assets, including ION, Orchard, and Raffles City. As of June 2025, it offers a forward dividend yield of about 5.0 to 5.5%, with a trailing PE near 16 and ROE of 6.25%. The macro environment and hybrid work trends have pressured valuations, but the REIT remains well managed with disciplined occupancy and tenant mix. NAV per share is around 2.13 S compared to its market price in the 2.0 SGD range, signaling modest upside. Another Singapore-based company that I own is Sea Limited. Sea Limited is a Southeast Asian internet powerhouse, behind Shopee, Garena, and SeaMoney. Sea is a strong regional play, but valuation is rich. I'm looking to exit and redeploy the fund to my other real estate holdings. Next up, I also have Eli Lilly as a very small holding, currently trading at around 25 to 26 forward earnings, with strong FCF and a yield near 1%. The growth runway remains long, and any short-term profit headwinds create buying opportunities. Another healthcare stock I also entered recently is United Healthcare Group. Recently, the price is extremely attractive. However, future remains uncertain, as the weakness was driven by rising costs in their Medicare Advantage business. I'll hold to maintain healthcare exposure and wait for margin recovery before considering adding. Next up is Broadcom, a powerhouse in semiconductors and infrastructure software. In Q1 FY 2025, Broadcom posted record revenue of $14.9 billion, with adjusted EBITDA at $10.1 billion and non-GAAP net income of $7.82 billion. AI semiconductor revenue rose 77%, now $4.1 billion. The stock trades at approximately 100 times trailing earnings, but forward guidance is strong. It's a high-quality, broad tech play. I'll hold core and consider incrementally adding if growth momentum continues and valuation moderates. I also have very small exposure to the luxury brand and goods, LV. This is a pure speculative play that I am looking to exit very soon. Coming to the end, I do own also Meituan Holding, China's leading local services and food delivery platform. Again, like other China holdings, I am looking to trim and exit once there's opportunity. Lastly, I have Haidilao International Holding. This is one of the largest hotpot restaurant chains in China, known for its exceptional customer service and rapid expansion. The company capitalized on China's rising middle class and dining out culture to scale aggressively across the region. However, the past few years have seen Haidilao overextend its store footprint during COVID, leading to underutilized locations and margin pressure. Although management has since slowed expansion and focused on efficiency, sentiment remains weak, and recovery has been uneven across its locations. While the brand still holds cultural significance and long-term potential, I view this position as too small and speculative relative to the portfolio. I intend to exit and reallocate to higher conviction consumer or dividend-paying equities. So, that's all I have for you today. This wraps up my $100,000 portfolio review. Every position here reflects a thesis. Some still valid, others being phased out. As you can see from my portfolio, I made many mistakes and wrong bets too. While my winners are covering way better than my losing positions combined, the key learning I want to share with you in this video is to adapt, learn, and compound better over time. Now, I want to hear from you. What do you think about this portfolio? Leave your thoughts in the comment below. Thanks for watching. And if you enjoyed this deep dive, subscribe to the Investment Diary for more real-time insights on managing capital with purpose. See you in the next diary.